Hello, I am about to report the general principles of bank management. And the bank manager has four primary concerns. It is liquidity management, asset management, liability management, and capital adequacy management. I will discuss the liquidity management, asset management, and liability management. And the adequacy management will be reported by the next reporter. As we say liquidity, it is to manage the cash. In every bank, there is a minimum requirement, um, reserves requirement that depends on their deposit, because too much cash may cannot be profitable. And as we say asset management, it is mostly obtain high interest rates from good borrowers, and also focus on reducing risk. As the liability management, it is the sources of funds, like the deposits. Next is liquidity management and the rule of reserves. Let's say the First National Bank has a reserves requirement of 10%, where there's $100 million deposit in the bank, which is 10% times 100 million is $10 million. The exists reserves. Suppose that the First National Bank initial balance sheet is as follows. The left side's assets, this has reserves of 20 million, loans 80 million, securities 10 million, and the right side liabilities, deposits 100 million, and bank capital 10 million. So here the reserves has a exist of 20 million, which is not profitable because it has too much cash. Let's say that there is a deposit outflow of $10 million, where in here many people withdrawn from their account, and it is a severe event for most banks, because 10 million will be a big man. The account would be in the left side and the right side, assets and liabilities. As you can see, the reserves and the deposits have decreased by 10 million, because the money that being withdrawn by the people will be deducted from reserves and the deposits, which is it is still safe for the bank because they follow the reserve requirements of 10%. This is more likely to be profitable. Here's another example with no exist reserves. Enable to contrast to the first example, also follows the same reserve requirements. Yeah? And it also has the severe deposit outflow of $10 million. In here, the reserves is now zero and the deposits has 90 million, which is now in this account or balance sheet. It has not followed the reserve requirements, which the bank should do a fast action for this matter. So what will be the banks do? To eliminate this shortfall, the bank has four basic options. One is to acquire reserves from Fed, because they said that 2008 and 2009 the federal banks has prints money to provide for the commercial banks. They sell it by cheap loans. But the commercial banks do not have to acquire from feds. They can borrow from other banks or corporation. They borrow from each other and also sell marketable securities. Sell some of their securities that they have to able to acquire funds. and also sell or call in loans that they have acquired. This is the account that the borrower that borrows from the other banks or corporation would be. In the assets side, assets have reserves of 9 million, which is reserves requirement needed by the regulation. And on the liabilities side, there is now a borrowings from other banks or corporations. And this is also the account of selling of marketable securities. In the asset sides, the reserves has $9 million because you have sold the securities of where the 10 million is now 1 million, and the bank and the deposit is also the same in the liability sections. This is also from borrowing from central banks or the federal banks. You have 9 million on your reserves in the asset sides, and also has the new account of borrowings from the feds of $9 million. So this is the account for selling or reducing or call-in loans. The asset will be reserves 9 million. The loans will be 81 million by call-in some of your loans by that 90 million deducted by 9 million. So when a deposit outflow occurs, holding excess reserves allows the bank to escape the cost of borrowing from other banks or corporations, selling securities, borrowing from the Fed, or calling on or selling off loans. Excess reserves are insurance against the costs associated with deposit outflows. Those those times that many people withdrawn their accounts, and the higher the cost associated with deposit outflows, the more excess reserves banks will want to hold. Let's go now to asset management, where it is mainly to obtain higher interest rates from the good borrowers. Yes. It said that to maximize its profits, a bank must simultaneously seek the highest returns possible on loans and securities, reduce risk, and make adequate provision for liquidity by holding liquid assets. Banks try to accomplish the three goals in four basic ways. Below, it is the basic banking. The lender savers will put their money to the bank, and the bank will give them interest rates from what they put in the bank. And the bank, those money that the lender savers put in it, this will be make into loans or sell this or borrow these funds to borrower spenders, and the borrower spenders will pay back the money that they have borrowed, the principal and the interest rates, which the bank will have to get the highest returns possible. This is the four basic ways to get the three goals. First, bank tries to find borrowers who will pay high interest rates and are likely to default on their loans. This is the good borrowers. Second, banks try to purchase securities with high returns and low risk. This is where the another bank who have cheap securities that is likely to default. Third, in managing their assets, bank must attempt to lower risk by diversification. It is where what the bank has, they have to put it in different banks, in many different banks. Finally, the bank must manage the liquidity of its assets so that it can meet deposit outflows and still satisfy its reserves requirement without bearing huge costs. The last part that I will be discussed is the liability management, where liability management is mainly to acquire funds, source of funds. So that's why the bank will attract depositors or borrow or issue certificate of deposits. Many large banks began to explore ways in which the liabilities on their balance sheets could provide them with reserves and liquidity, and that is to attract depositors, borrow or issue certificate of deposits. These two, they aggressively set target goals for their asset growth and tried to acquire funds by issuing liabilities as they were needed.